Hello, everyone, and welcome back to TradeFinder Live. It's great to be back with you all on this trading day and trading week. I'm very excited to get into lots of exciting topics for this session with Mr. Rob Roy, who I'll be introducing here in just a few moments. But first and foremost, we have to cover our disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. It's available on our website at all times, so please feel free to read it in detail at your leisure, or take a screenshot of it now if you like, but that's the main point to take away from it. Other than that, it seems the market's continuing higher, and that's in anticipation of multiple Fed rate cuts. And I don't know if the weekend's news might affect the markets. Very interested to hear Rob's thoughts on that overall. And of course, very excited to interact with everyone who's joining us live. So without further ado, the man of the hour, Mr. Rob Roy.
Hey, Zach. Welcome, everybody. Happy Tuesday afternoon to you. Take a look at where we are with the markets. We made a comment about the weekend's activities. Everybody knows what happened there. We don't play politics here, but talk about how the current political situation affects the markets, and that's it. And it does seem like we have continued this move to the upside, which did start based on the likelihood of multiple Fed rate cuts. There's some quasi pricing in of July. I don't believe that the Fed's going to cut in July, although Powell has been awfully dovish lately, starting with his comments from the congressional testimony, the old Humphrey Hawkins testimony, where he did seem a little more dovish. And then we got the lower PPI number right after, pardon me, and then the higher PPI number. So that does compress margins. If you have higher pricing on the wholesale level, but you can't pass it on to the consumer, an indication that perhaps the consumer is not spending as much, that does hurt margins. And we'll see how that plays out in the next earnings cycle. But we just started this earnings cycle in earnest, but it's too soon to see those reflected. But I still don't think the Fed will cut in July. I'm warming to the idea of September. You know, I've been talking about how I just don't think they want to go before the election, but if they have to, I suppose they will. I still think December is pretty much a certainty. That's baked in the cake, and now it seems as though September is, and perhaps a little bit of wondering if we're going to get that July cut. I think that'll be a disappointment because I just don't think the Fed will cut in July, but I wasn't really on the September train either, which seems to be moving forward based on the recent economic and inflationary data. As far as what happened over the weekend, obviously there's speculation of a potential sweep by the Republicans. And if you go back and look historically, I'm not a big election cycle person. I know some people pay a lot of attention to that. I think every situation, every election is different. But the one thing that I do know is when historically the market does better, it's when you have almost a stalemate. Like you have one party in the White House as president, and then you have a split Congress. The market historically has performed worse when one party controls everything. And there's kind of this viewpoint, I think, that it could be a Republican sweep. At least if the election was to happen now, that's what it looks like. We got a long time between now and November, so a lot of things could change. I think a lot of the emotion will calm down. But the market historically has not performed that well. The market kind of likes almost gridlock, not total gridlock in the markets, but they do like it when there's a bit of a balance between the parties and power. So we are moving higher. We are in that melt-up scenario that I've been talking about. I do like the fact that we're on more of a 45-degree angle playing now, not that vertical stuff that was going on. So that is more constructive to the movement of the markets. You can see that we really are right in the middle of that Wave 5 tap box. That's something to take into account when you look at where we are right here. Right, almost dead in the middle of it. We could go a little bit higher to hit the midpoint, but we're in that tap box, and this is where you start to wonder, are we going to see a relabeling of this 5? Now, if this 5 relabels to a 3, then you have to go by what the markets are telling you, and we could be heading even higher from there. But if this stays a wave 5 and we stay within the confines of this tap box, then perhaps we get back to that buy the rumor, sell the news scenario where the market moves up in anticipation of Fed rate cuts. And once they finally do start cutting rates, then we get the corrective move. I think that makes a lot of sense. I put the DMI on the chart down here because I wanted you to see that because it's getting awfully high. A couple things to note here, that the ADX is powering higher. It's above 40. It is telling you that there's strength to this move. However, take a look at where we are with the positive directional indicator. It's actually moved down below the 10-day moving average. No increase on the sellers. So the sellers have stepped away. They're just like, we'll let the buyers have it. But even the buyers are starting to wane in strength. So we've got some separation between the positive directional indicator and the ADX, which is never a real positive thing from at least the DMI as an indicator. So it's telling us that this move has been strong. But remember, the ADX part is a little bit more of a lagging indicator, and the ones that are more responsive to the day-to-day moves are these two directional indicators. So as we start to create this divergence between the positive directional indicator and the ADX, I think that signals that this is likely going to stay a wave 5. The ADX is just too high, I think, to see a relabeling of this 5 to a 3. So I've been pretty much with the same theme for months now, cautiously bullish, but you have to remain that, keep that little caution mode in there. We do have a little bit of market rotation, which will feature from both the financial sector, which is good, but that's what you expect as you move into rate cuts. You would expect the financials to move better, but they're all moving vertically. And then the IWM, the small caps, are moving vertically as well. So it makes it really hard to take advantage of this. I have found a case study that's not quite as vertical as some of the other financials, and Zach will come in later on and show you how to put that in. And by the way, while we're talking about our case studies from TradeFinder on the case study considerations, we closed out GDX, which actually hit our target spot on. We also closed out SLV, which hasn't quite hit our 30 target yet, but it's made a nice breakout from the triangle. We consolidated, we moved higher today. It was a good opportunity to go ahead and take that one off. So couple of positive continuing case study considerations in TradeFinder. And something that you might find interesting is over the past 2 days, we've closed out 5 of our alert case studies. These are alerts that are sent out to our alert subscribers at ewotrader.com, and they've been a combination of different strategies. They haven't all been the impulse strategy. And something that I want to mention, we are actually doing a webinar tomorrow night where we're going to feature our multiple strategies. So what we call the platinum, where you have more than one strategy, and it's worked out extremely well this year. When one portfolio was doing really well, it was making up for other portfolios that were really not seeing many signals, kind of quiet. Nothing was really going down that significantly. You just had some quietness in one portfolio, and the other portfolio carrying the mantle and running with it. So, Zach, if you put that link in the chat box, you can join us tomorrow night at 8 p.m. Jeff will be here as well, our other Ewo trader, and we're going to cover all the different portfolios that we have and explain to you how they work and the differences, and then give you an illustration of how they've been complementing each other this year. So we're kind of going to do an illustration of what we do at ewotrader.com, if you will. So we'd love to have you join us. So if you click on that link and register, you'll be notified and be able to sign in to the webinar. Once again, it's tomorrow night at 8 p.m. And we'll be talking about the platinum level on ewotrader.com, covering all the different portfolios. So if you've ever wondered, what all do you guys do? Well, we're going to give you a rundown of it. That's basically what it's going to be. So, at TradeFinder, we give you case study considerations, and then we leave you to it, and it's just one case study. Well, how do you manage portfolios? And if you're a trader, if you're wanting to be a trader, I've talked numerous times that in the world of trading, there's multiple different scenarios that people use. Some just want to generate extra income. They like their jobs. They're happy with where they are, and they want to put their money to work to make a little bit more. Or perhaps you have designs of trading for a living, which I've been doing since 1996. So join us, and then you'll get a good rundown of how it works in the professional trading world. So I just wanted to put that out there. Love to have you join us. All right, so let's get back to what's going on in the markets. I will get to the IWM because it's in the stratosphere right now, but let's talk about interest rates first. And so far, I've been really surprised to see what's gone on with interest rates and the IWM. If we're not broadening in the rally, and that's where financials historically, the viewpoint has been, it hasn't been working that way lately. No doubt the AI stocks have been driving us. You've read everything about how narrow the breadth has been. It's been confined to a handful of big tech stocks that have been moving the markets higher, specifically in the S&P and the Qs. But the IWM with the small caps is normally, when you branch out that way, a size of a broadening of the breadth. In other words, money is rotating away from just small individual stocks. So that's one thing to take into account. But the other thing to consider as far as whether or not we're broadening or not is the financials. There's this age-old viewpoint that you can't have a market rally without the financials. Well, we've already kind of squashed that this year with the fact that the AI stocks have been moving up just in thought of interest rates moving lower, and that has been difficult for the financials. So we've still been moving up without the financials, but now the financials are playing catch up in a big way. So is that telling us that we're going to continue higher? Once again, my theme has been that we will continue this melt up into the election, and then we see. And then I think caution takes over optimism. So now that you have cautious optimism, we might take the optimism part off of there and just say, all right, now it's time to be cautious once we do get to the election. But back to the small caps, we did have this move down, and we broke down below the 100% extension on the TNX, but no follow-through day. You know all the rules. You've been watching these. You have to have a follow-through or confirmation day. We didn't get it. We're still stuck on this 100% extension. Now, had we continued down here, that could have been an explanation for why we're seeing, and here we go, on the IWM, this craziness on the vertical movement. Look at that move on the IWM. You can't chase that. It's showing up on all my searches, but there's no way you chase that kind of a move. You can see the separation from where we are on the IWM versus where we are on rates. And there's a viewpoint that the IWM performs better when you do have a lower rate scenario. So when you see the IWM doing this, you would have thought that we would have had a continuation down in that TNX. Hasn't happened. So even with rates stabilizing, which I actually think is constructive, remember, gosh, there's so many things to talk about. Remember, we talked about you don't want rates to go too low. I didn't necessarily think we wanted rates to go down to the 161.8% level, because that does indicate that the economy is significantly weakening. So there's a little bit of a dichotomy going on where if the economy is weakening enough for the Fed to do multiple rate cuts this year, why didn't rates continue lower? Why have they held right here? Maybe they hold and then they go lower, but it doesn't make sense. If we're going to see the IWM move up like this, you would have thought that we did have follow through on the TNX, and we're moving down to that 161.8% extension. So if you take that as one of the causes out, then you have to start to look at maybe the rally is broadening out, and maybe the IWM and the small caps are giving us an idea of the market is more favorable to risk on. And then the financials leading, as I said, historically has been a good signal for the markets, although they're just playing catch up right now, and they're rallying because of the fact that we're now pricing in multiple Fed rate cuts. That's why the financials are going so vertically. But this Russell stuff is just nuts. Please don't chase that. You can see that there is just tremendous separation from the 10-day moving average. We've gone straight up vertically. What goes vertically up oftentimes comes vertically down. We do need that 10-day moving average to catch up. And what would be healthier for the small caps, because we've just blown through this resistance area at 210. You've heard us talk about it so many times, that we've been in this range between 190 and 210. This goes back years. We had that brief period where we broke below 190 and we moved into the range between 170 and 190. You've all heard this numerous times, but we add viewers each and every week. So that's why I repeat myself. I repeat myself for two reasons. One, for the new people that haven't heard it before, and to reiterate these rules that are so important for those of you that view us each and every week and perhaps haven't incorporated those rules into your trading. Those that have been with us at Ewo Trader for a long time and have gone on and they're doing well on their own trading, talk about how these rules have really enhanced their trading and helped them to go off and trade on their own, which is really the motivation at EwoTraderLive.com. We do have an alert service, but that's just to help you to earn while you learn. The idea is that we want you to be able to have the confidence and have the track record to one day just go off and trade on your own. You don't need the alert service because you've learned all these rules. The software, you kind of need that if you're going to be an Elliott Wave trader. I've yet to meet the person that is successful trading Elliott Wave that didn't use software. And as you've probably known from all my countless recants here, this software is produced by HUBB.com. It is programmed exactly to the algorithm as Ralph Nelson Elliott wrote it. You need software to trade Elliott Wave, but you don't necessarily need the alert service if you've learned well. So if you learn how to read the charts, you've learned the rules on Elliott Wave, you've learned all the educational stuff that we do for you at EwoTrader.com, you can just take the software and go on and trade for your own. But if you feel like you want your hand held a little bit more than what we do here at TradeFinder, then visit us at EwoTrader.com and join us tomorrow night, and you'll get an idea of how things work when you manage multiple portfolios. But this is too vertical, so we're not chasing this IWM, even though it's showing up on all the searches. Way too vertical. We're going to get one or the other. We're either going to get the IWM to do a little backing and filling and let the 10-day moving average catch up, or we're going to get the IWM to back up a little bit. It's almost to the point where you would think, gosh, that looks like a good short rather than a long, just because of the fact that it's so vertical. And then when we take a look at the dollar, let's see what the dollar is doing with all this. And it's trying to break below that 104 level. And you would expect that. Rate cuts are not supportive of the dollar. The fact that the dollar hasn't come crashing down, I think, is a good sign. It shows that there's still faith globally in the U.S. dollar, even with all the debt that we're carrying. I think what happens is the viewpoint is, well, if interest rates go down, then it costs the U.S. less to service the debt. And we know we have a mound of debt here. But if we're going to get a break from rates and it's not going to cost us as much, then you don't get a big move down in the dollar. You get kind of a trading range. And that's what we want. To me, that's what we want to see. If this dollar stay in this range, we're getting awfully close to that wave 4 that held right at the 61.8% wave 4 correction. Maybe we break that. If we do, then perhaps this dollar relabels, which I would like to see. I've talked about, I don't really want to see the dollar go up here because now you have a double whammy. Now you have the PPI showing producer price levels at the wholesale level costing more, not being able to pass on those additional costs to consumers. And then if you're dealing with an increased dollar, and so that hurts margins for global companies, that just sets us up for a pretty rough earnings cycle next quarter. I'm not talking about this quarter that just started with earnings. I'm talking about next quarter, which happens to coincide with right around the election time. So things are kind of lining up to be pretty cautious around the election. But now we look at what we have moving on. Let's look at the DIA, and it has moved up. This is kind of crazy too, in my mind. We did hit the 100% extension, and then the next level was to come up and hit this resistance here, which we did. We talked about that. And then I also talked about if we move up to the 161.8% extension, would this wave 5 move from these highs here in May over to these new highs here if we were to break them, which we did, or would we relabel to a 3? And look what happened. We relabeled to a 3. So I've been talking to you about that, about the possibility that that 5 relabels to a 3, and that's what's happened. So we are probably going higher in the Dow, but once again, too vertical. We're straight up. We're too far away from the 10-day moving average. We need that to come catch back up a little bit. It's not as overbought as the IWM is, but it's too vertical and it's too far away from the 10-day moving average to chase. Now, what would be ideal is if the DIA came back down somewhere around this 400 level, perhaps tested this, what was resistance becomes support. And if you've been watching for a while, you know that my mentor, when I first started trading, and it's so helpful. I mean, the market's happy to educate you, but it's extremely expensive through making mistakes. It's much better to follow along with somebody that's been doing it for a while. And I can speak from resistance. When I first started trading, I made a lot of money and thought I was the next guru and I knew everything, and then gave a big chunk of it back and realized maybe I better get some guidance. And so that's when I found the guru that I listened to. And one of his big keys was the third time's the charm. In other words, when you test a support or resistance level on the third time, what happens on that third test tells you where the markets are likely to go on the near to intermediate term. So the fact that we have broken that resistance means that it's very likely, and the wave 3 is confirming that we're going to continue higher in the Dow, but maybe not over the next couple of trading days because we're getting a little too overbought. So respect when we get overbought. Wait, be patient, let it come back and fill a little bit. The other side of the coin is if you try to chase this, these premiums are so juiced right now, so much IV being pumped into call options on all these markets with all these vertical moves. And you could actually buy calls now and have the Dow go up. And if it does stop this vertical stuff and go on a 45-degree angle, you're going to find out that your calls aren't really making money. And you're wondering, why is the market going up and the call's not making money? Because if this vertical stuff stops, all that extra volatility is going to come out. And that comes out of the premium of the options. So even though you're right on direction, your options aren't making a profit. And that's the idea, right? So when I caution you about chasing these vertical moves, there's a lot of reasons why. Let's get to the Qs. And note, the Qs aren't doing all that vertical stuff. So this goes back to maybe we are getting a broadening of the rally, moving into financials, moving into the small caps. But man, people have flooded into them. So we don't want to chase the vertical stuff. But looking at the Qs, we're doing okay. We got a little bit above the 10-day moving average. We're holding the 10-day moving average. We've got a little more to go to hit the C wave extension within the wave 3. So we're starting to get, instead of the discombobulation, as I call it, where the markets have different LA wave labels, are starting to move into the fact that perhaps we are all relabeling to wave 3s, which means that we do move higher, just not in the next few days. We need to satisfy some of these overbought conditions. Now, do we recreate a bid in the Qs as we correct these overbought conditions in the other markets? Maybe. I mean, the Qs aren't telling you to get out, so I want to be clear on that. They're not saying, there's no signal here that's telling you to exit anything long on the Qs, but you can clearly see from the charts they're not participating in that vertical stuff that was going on in the other markets. All right, let's look at the VIX. Did the VIX break down below 12.5? No. Isn't that amazing that even as we continue up in the markets and vertically up in some of the markets, the VIX just will not consistently go below that 12.5 level. We've actually broken a little to the upside out of this descending triangle. And is the VIX kind of telling us, hey, this market needs to calm down a little bit? I think maybe that's what's going on. We're too vertical in some of these. There's volatility, specifically in the call options. Don't chase those vertical moves. And perhaps the VIX, by creeping up a little bit here and breaking above that lower trend line, the descending triangle, is telling you that maybe we actually get some down days here in the markets to correct some of those overbought conditions. So to summarize here on the markets and what the VIX is telling us, I think that we've had these big moves and we need to consolidate those moves, backing and filling. And so perhaps maybe we actually see some down days, perhaps a little bit further tick higher in the VIX. That would all seem to make sense. That would all seem to flow together. But once again, the markets don't always give you the ideal scenario, but that does make a lot of sense. Now let's get to Bitcoin, because things are changing quite rapidly here in crypto land. You can see that we came down here. We talked about breaking 60,000. If we did, we would probably come down here into this area rather quickly, which we did, which was the little consolidation that we had back in February. So we came right down to it, bounced off of it, and then we said, don't get too excited too fast, because we still have to get back above 60,000. Well, we have. And now we're up testing 65,000. So breathing easier in crypto land if you're long cryptos. Now you just want to see that 60,000 level hold. We're a tiny bit overbought, but not significantly so. From the 10-day moving average, we do have resistance here at 65, so maybe that's the end of that bump. And if we're going to continue in this 5-wave pattern to the downside here, we're right at the 61.8% fib level. So you would think, okay, this is an ideal area where perhaps we bump our heads a little bit on this move back to the upside that we've had in cryptos. A little bit of consolidation here would be good. Get above 65,000, and then the next step would be, can we finally break 70,000, which we tried all through the spring and into early summer. Couldn't do it. You just kept acting as resistance. Well, are we going to do that again? In order for that to occur, this 5-wave has to relabel. And if it does, then perhaps we are going to go up and test 70,000. So perhaps you've enjoyed this little bounce, but be wary that maybe we get a little resistance for a couple days here. Ethereum, same thing. We got back above 3,500 or right to it. But look, the chart is identical to the Bitcoin chart. We're still in technically a wave 5 to the downside. The wave 4 has recovered right to that fib level. We're also at a point here of resistance at 3,500 because it acted as support for a while. A little bit of separation from the 10-day moving average here on Ethereum as well. So maybe we need to get a little bit of a breather here in crypto land, and we calm down just a bit before taking the next run at the next level. And for Ethereum, that would be a move back up towards 4,000 if we can get above 3,500 and hold it. We're testing it now. We need to get above it with a follow-through day. So we held support at 3,000, which was needed. Here's a level down here at 2,500, which is where we were going if we didn't hold 3,000, but we did. And so that held in there. Now we're testing that old support level as resistance, and can we get above it? But a little bit overbought, and you don't want these two cryptos, Bitcoin and Ethereum, to jump above these resistance levels on this same vertical path, because if it does, they don't hold. What we want some sideways consolidation right under these levels, gather a little more energy and momentum, then break above the next resistance levels. That usually takes you to the following one, which in the case of Ethereum would be 4,000. In the case of Bitcoin would be 70,000. So that seems to be a good place to be. Now I want to show you silver. As I said, we did take our case study off, even though we haven't quite gotten up here towards this 30 area yet. But we broke out nicely from the triangle. We consolidated this breakout move. And my concern here is that we haven't come back down and tested the point of the breakout. That will happen at some point. It doesn't have to happen right away. it could be well into the future. It's just like gaps getting filled. We know based on our AI data, and we went through and searched that 94% of gaps get filled. It's not 100%, but we don't know when. Sometimes it's well into the future when they get filled. Sometimes it's immediate. So silver didn't come back down. It is holding the 10-day moving average. So if you wanted to stay in here, you could. The reason we went ahead and took that case study consideration off as a nice gain on TradeFinder on the website, which again, Zach will show you here at the end of the hour, is just the fact that we haven't tested this point yet. You've got a nice trade. We had the nice breakout. I wouldn't begrudge you because these zigzags work so well. If you wanted to wait and see if we could get up into that 30 area, that's fine. But my thing is more, let's take a piece of profit out of the move. We don't necessarily have to hit the bottoms or the tops because nobody does that consistently. But if you wanted to stay in this and follow along with it, I could understand that. And perhaps we do go up to 30 and maybe you do a little bit better. But the fact that we had a nice update today, breaking above that 10-day moving average, holding above that 61.8 seemed like a good time just to say, we had a nice gain. Let's take it. But if you want to hang in there, I would certainly understand that. So let's look at gold. This is another point of what I was talking about as far as our webinar tomorrow night when the impulse strategy, which is the directional strategy, was quiet for a while. There were tons of these triangles, just like GLD. We had a whole bunch of them. And of those 5 profitable trades that we've taken off in the past 2 days, triangles have been part of that. And GLD was part of it. Look at that move. Nice breakout move. Again, a little separation from the 10-day moving average. Perhaps a little resistance right here, but we're getting through it today. So we're in a wave 5. Maybe we continue higher on GLD. You've got a nice trade. You got a nice breakout. And so gold's working extremely well. And it was a great strangle trade in our volatility portfolio. So the metals seem to be constructive. Maybe we got out of both of those a little bit early. We took profits on both. So, but when the old expression, you can't go broke taking a profit, and you can't second guess yourself. We could easily come back over the next couple of days and see SLV and GLD higher. So what? If it goes higher, great. Happy with the profits. If you're happy with the profits when you take them out, don't second guess yourself or you'll drive yourself nuts. There's enough emotions that we try to take out of trading. And if you start getting on yourself about trying to be too perfect, that's when you start making mistakes. That's when you stay too long. And that's a negative. So nothing wrong with getting out too early. A lot wrong with getting out too late. Does that make sense? Because if you wait too long, you have what was a profitable trade potentially turn into a loss. And that, I can tell you from experience, is the worst feeling in the world of trading. It's not that you got out too soon. You could have made more profit. You didn't get in at the bottom. You could have made a bigger move. If you still make a gain, all that stuff where you can go back and second guess yourself. You're second guessing yourself after taking profits. But when you have a profit and you hang around too long and let it turn into a loss, I mean, that's a lot harder to get over from an emotional standpoint. So anyway, just some psychological thoughts to throw in there. Let's take a look at oil. As you know, oil was on the move, and finally we're getting a little bit of a break. We did go right up to the 61.8% level here, and we've backed off. We were trying to hold the 10-day moving average, and now we're finally getting a little break. Maybe 3 months from now, we'll see that at the gas pumps. You've heard me with the conspiracy stuff, and it's just how it works. I'm always, I'm a little bit of a conspiracy theorist, but I'm also of the belief that, is it really a conspiracy theory if it's based on fact? You all know that when oil goes up, you see it reflected at the gas pump the next day. And when oil goes down, it takes weeks before prices come down. How do they get away with that? I have no idea. I've been bitching about this for 20 years, and it's always been the same. But at least a little bit of a break at the gas pumps, maybe a couple weeks down the road. If oil turns and heads back up, then maybe they never even bring the prices down. But I would like to see USO come down here to the 10-day moving average, get to the 50% level here, and then perhaps we have a new zigzag pattern. We can start to measure that. The negative being that if it is a new zigzag and we come down here and it's qualified, that means we're going to have oil higher in the future. And so what we've seen at the pumps is just the beginning. It's going to get worse. But for now, we are setting up at least for a tradable pattern. I like when we do on Thursday night, we do a webinar for our alert subscribers only. And we do an extended Q&A. And one of our subscribers was talking about a great pairs trade. You hear about pairs trade all the time where you go long one, short something else. So perhaps you go long a sector that's doing well and you short the weakest link in the sector. Like there's a company that's, this sector should be doing well. All the stocks should be doing well. Why isn't this stock doing well? So there's different ways that you can pair off trades and manage risk. But a pairs trade here would be, well, we're all feeling it at the gas pump. If you have, a carbon-based emissions vehicle, obviously it doesn't matter if you're driving an electric car, but go long oil and you can make profits on your oil trade to help offset the cost of the gas pump. So there's all kinds of different things you can do. But I thought that was a good insight, and we have a lot of fun with the commentary and stuff. All right, so let's take a look at a couple additional markets. I did want to show you because people have been asking about this on YouTube. If you haven't looked at the weekend's U.S. market update on YouTube, please go and do that. Saying that, we show India all the time. Well, India has been where the action is. Can we show China? Well, here's the FXI, and you can see right when it looked like it was going to break out, right back down. Now, we do have a pretty solid wave 4 here at 50%, but we got a false breakout here, and we came back down. Maybe we're just going to test this wave 4 again, and we can turn and start to go back to the upside. That would be positive if we did that, but we'll have to see how that plays out over the next few weeks. But if we break this wave 4, then if you want to be bullish on China, you can't be. That would be your stop. If we hold this wave 4, you can stay long China, but if we break the wave 4, then you got to get out. And then let's go back and look at the INDA, and it's still continuing to power higher. That's why we look at it all the time, because it's just it's in the stratosphere here. Now, we just saw how we were seeing some relabeling on the U.S. market charts. Are we going to see a relabeling on this INDA? That's what I'm watching for now, because I can't chase something that's at 169% extension. We're above that 161.8% level. I've mentioned this before. Over my years of trading, handful of times you see something go to the 261.8% level and stay in a wave 5. Doesn't happen often, but it has happened. Or this 5 relabels to a 3. If that happens, then I think you can say, hey, this move is not over in India, and we can stay in there. But for now, I think it's a little bit overbought, hard to chase it now. And I know you look at it going up every single day, but I don't like this fact that we're above the 161.8% level. It's exactly what happened in the Qs, and then they relabeled to a wave 3. So let's just be patient here on the INDA, see if we get a little relabeling here of a wave 3, and that could be a new opportunity on the INDA. But now it just seems that we're getting awfully extended there. Let's take a look and see what the DMI is showing. And when you look at this, it's setting up, and you have to admit that's about as constructive as the DMI looks. So if you want to know what does the DMI look like when it's showing that there is strength to a move and a likely continuation of it, that's it. That's what it looks like. So I'm feeling like the DMI is leaning towards showing us that there is a likelihood that this 5 relabels to a 3 on the INDA. So let's see how that plays out. Worked with the Qs, same type of scenario. Let's see if it plays out that way on the INDA. Some stocks of interest to look at. I know we've all been asking about natural gas. It gave us a little head fake here. We had the wave 5. We went back to the previous 4. We've gone sideways. Now we're back down here at 15 again. And Zach, cue it up, because if UNG can't hold 15, than we are in the old
KBTD.
Yep, that would be a Katie bar the door, because that's going to bring UNG right back down towards 5 again. But we
Yikes.
haven't broken it yet. We are trying. We're at 1460, but you can see we broke it yesterday, but this doesn't count as a follow-through day yet. But if we close lower today, then that's a follow-through day, breaking below 15. And I know we've all been wanting, some sort of a bullish trade on UNG. And it just gives us these real quick head fakes where we think something's going on and then it doesn't do anything. But now we have to start looking at, if we can't hold here today and get back above 15 in the next day or two, we have to start thinking about UNG going a bit lower. So let's look at SMCI is another one that I wanted to look at. We'll look at our really the only one we have left is Microsoft. Is the only thing we have left to look at on our current, what would be considered open case studies, because we closed out GDX and SLV off of TradeFinder. And this is why I cautioned. We had this move up, and I know there's a little bit of a bid being kept under SMCI, even as the Qs are, you'd have to say, underperforming the other markets. Even though they're going higher, they're just not performing as highly now. They have been the driver for quite some time. They needed a break. The only reason SMCI hasn't come back down more, I think, is because of all the whisper that they're likely the next one to announce a stock split. That's where, pardon me, the bullish scenario is for SMCI. If you're wanting it just from a purely technical standpoint, you need to see it get above 1,000. If we can get SMCI above 1,000, all right, now you got a bullish trade. But until it does that, you're only trading SMCI long on the hope that they announce a rate cut. Not a rate cut, stock split. Excuse me. It's hot here in Florida. Pollen counts are off the charts. Threatened to have some rain yesterday, and we didn't get it. Maybe we'll get some today. But we are holding the 50-day moving average. So, again, I can't begrudge you if you want to be long SMCI with that potential stock split announcement, maybe all the whispering. But if it breaks below the 50-day moving average, then you even have to exit that trade because we're probably going to come down here and test this support down around 750, and that would be a big move lower. But once again, if you don't want that aggressive trade on the potential for a stock split, let it get above 1,000. And if it does that, then from a technical standpoint, that's bullish. For now, we still are technically holding a 5-wave to the downside pattern here. Again, I think what's held it from really coming down further with the Qs taking a break is that potential for the stock split. And then NVDA doing exactly what I thought it would do. This 45-degree angle, you can see that we get a move up, we come back down. Now we are trading below the 10-day moving average today, which we have not done for a while. But this is way more constructive on NVIDIA. You're not going to get this day after day upward move that we had in the past. I've already gone through and given you all the reasons why for that. It just doesn't work that way. And so I think this is pretty constructive. Now, the case study consideration for today is going to be COLB. And believe it or not, this is one of the lesser vertical moves. I know it's vertical, but these stocks are going so vertically up. What you want to do when you see this, if you want to follow it now, is you put on a smaller position. And if we do get a little backing and filling, then you add to it. But the target price is $1 higher. So we're only looking for $1 move. It's a $23 stock. We're going to look for it to go up and fill this gap, which I think is exactly what's going to happen here. So that's going to be where our target price is. So just $1 move from here. And don't go all in. If you want to follow it, do whatever your risk management is, do maybe half a position. Then you still benefit if it continues vertically up there, since it's not that far away. But this is how difficult it is to find something right now, because everything that looks bullish has gone to vertical. So this is one of the better ones, and there is some liquidity in the options. So that's going to be our case study consideration for today. Zach, I'll look at Microsoft, then we'll take a few questions, and then you can come back and show the folks how to post COLB on the platform. So Microsoft, we have it going up to 475. We got up, came back down. Now we're trading right here at the 100% level. We could even come down here, test the 50-day moving average. That wouldn't concern me. In fact, I would like to see Microsoft come down here because I think that would be a good entry to add to the position. But we want it to hold right through here. So if we even break the 50-day moving average, we need to hold this wave A high here in the zigzag. If it breaks that, then the whole trade falls apart. But even if we come down to the 50-day moving average, that's fine. Even if we break the 50-day moving average, that's fine, as long as we hold the A wave high here. But you break that, and then the whole bullish scenario is gone on Microsoft. But for now, that's the only current case study that we would want to look at. So we'll keep that one going for now, and keep an eye on it if it does continue to creep back down. But again, I'd like to see it come down to the 50-day moving average. I think it gets pretty compelling there, especially with how vertically everything else has gone. Now, if we do get a pullback in the markets in general and a little bit of a blip up in the VIX, we probably get that test of the 50-day moving average on Microsoft, and then you get a more ideal entry. So with that, Zach, let's take a couple questions and then show the folks how to post COLB.
Sounds like a plan. Let's get right into it. We got a question here from Alex. If we assume that the Fed doesn't cut unless something breaks, what would be the trigger for the cuts? CRE, unemployment. Cuts don't lead to anything good. It uninverts the curve and recession. Thoughts? Thank you.
Well, yeah, I mean, that's what happens. And that's why I think it's a buy the rumor, sell the news. Because once we do get to the rate cut scenario, that means the economy has weakened. Inflation's not going up, and that would be a confirmation that the economy is weakened. At least the one thing, and we had a really brief period where that was a concern of stagflation, but you haven't heard that word for a while. So inflation coming down is good. The economy weakening, we needed that for the Fed, even though they said they don't want to unduly harm the economy. I do believe that going into election. I feel like if this wasn't an election year, I think they would be more hawkish. I think they are trying to play the neutral ground in politics, and Chairman Powell even said as much in his testimony in front of Congress last week. So just remember on the yield curve, if it uninverts, that doesn't mean that we're not going into a recession, because the yield curve, when it inverts like this, it signals a recession 12 to 18 months down the road. It's not an immediate indicator. So if it uninverts, it doesn't mean, okay, we don't have to worry about a recession. No, the damage has already been done in the bond market, and the bond market is screaming that a recession is coming. And even if the yield curve were to uninvert, I still think we're looking at a recession. The market's always looking ahead, and the indicator of an inverted yield curve typically is 12 to 18 months, and we're actually kind of past that now. So we had a negative CPI report, so inflation was down. Do we get a negative GDP report? And then you start talking about potential recession. So anyway, that's my thoughts there on the yield curve.
Thanks for the insight there, Rob. And I just want to remind everyone to hit that smash that like button, rather. Goes a long way for us if you are enjoying the webinar so far. And also don't forget to register for that event. I put it in the chat a few times. I'll put it in there once more before the end of the webinar. So we'll move on to the next question here from Abhishek. Thank you for your chart analysis on IBM and BHVN last time. They are running hot. Please analyze the chart for HUBS. Lost a bid from Google and hence the sell-off, but fundamentally looks solid. Thank you.
Okay, well, there's IBM because I heard that one first, so I was already getting ahead of you before you actually asked the question. And yeah, we talked about that one, and IBM got above 180, and this could be another catch-up trade here because IBM clearly wasn't following along with everything else that was going in with the big tech craziness. It's hard to ever count out Big Blue, which is the pseudonym or the nickname for IBM. We are getting up towards 190. Which could act as a little bit of resistance. But I feel like if we hit 190, don't be concerned about that. If it backs off a little bit, I just can't imagine that we're going to get this high and not go test 200. Now, it may not happen in the near future, but I think that's going to happen. So I'm sorry, Zach, was it HUBS? Was that the symbol that we wanted?
You got it. Yep.
Okay. So HubSpot and apparently, the person that asked the question knows more about it than I do. I'm not so familiar with this. So if they lost a contract here, then let's see where the next area is. So you don't trade at $450 a share if you're a poor company. So perhaps we're a little overdone on this move down. We came down right to a little bit of support there where that wave one was and what held as support for a while here. Back in October, we broke below it, but we got right back above it. So trading through this is what that's called, the 450 level. We came down and tested it. And this might actually be a decent entry here. But understand that when they fall like this, they could go sideways for a while. So this brings up, kind of another dichotomy, if you will. Do you go ahead and get in now looking for an oversold bounce? If you do, then you risk potentially extra IV in the options. Another scenario is the likelihood is that we trade sideways for a few days. The options quiet down. They become less expensive. And then you come in and buy and look for the bounce back up. It does look like the 10-day moving average would be the first stop, and then perhaps we come back and test 550. That's what happens on these drops. It could bounce right back to the 10-day moving average immediately or go sideways. So if you're more aggressive, then you can jump in now. If you're more conservative, wait and see if it goes sideways. If it tests 450 again, the risk there, though, is that if it does immediately go back up, then you've missed it. So that one's a little trickier. But I do think that based on the stock price there and all, it absorbs some bad news. But in the long run, the company's not going out of business or anything. So it does look like this could be a decent buying opportunity. Okay.
Yep, and losing a bid from Google can definitely do that. But as you said, it doesn't look like they're going out anytime soon. So that'll be an interesting chart to follow. Next up, we're going to go over to Will. Will would like to look at TOL on the weekly. And I got one more for you as well.
TOL, Toll Brothers. Because, with the potential for interest rates moving down, you could certainly see a little bit of bid come back into the housing market, at least for the short term. That may not last, but XHB is doing well. It's recovered. Nice move up here in Toll Brothers, but we're getting back up here into the stratosphere a bit. We had a question, which I thought was really interesting in our insiders meeting, again, the one for alert subscribers only a couple weeks ago, where they said with the Hurricane Center forecasting a stronger than expected hurricane season, would you look at lumber stocks, et cetera, things that would be necessities in the case of some hurricanes making landfall and causing damage? You saw it in Texas, et cetera, and that wasn't even a big hurricane by the time it got there. The water is extremely warm. I like meteorology as well. So I thought, I kind of said, well, the Hurricane Center is wrong a lot. And being born and raised in Florida, I can tell you many years they've been way off, but it looks like they might be right this time. And of course, maybe that's putting a little bit of a bid under the building stocks as well, because if stuff gets knocked down, it's got to get rebuilt. So a little bit of a bid coming underneath these builders from that potential, which is more of a black swan thing, because we have to have those hurricanes hit first. But then the little bit of a rate cut, we had gotten to the point there was some data release that the long end of the curve on rates getting above 7%, it was getting out of the affordability because the prices of homes haven't come down that dramatically. And maybe if we get some rate cuts and we bring rates back down, then that last wave of buyers, and I think we're near the end of the cycle of real estate moving up, those people that were on the fence but maybe couldn't quite qualify at a higher rate or have just been waiting to see if rates come back down, they step in, and then maybe that's the last hurrah. But it does make me nervous that we're right up here against resistance again on Toll Brothers, right there at that wave 5 and their separation from the 10-day moving average. If you caught the move off 110, Will, awesome. I just wouldn't chase it now. If it can show us that it can break above this 135 area, then maybe. But you don't want it to break it now. Again, sideways, let a little energy and momentum come back and then break it. And then, maybe that move continues. I could see a case from it if we start to see things heat up out there in the oceans again. So let's do one more,
Yes,
Zach.
indeed.
We're at the hour, and then let you take the folks and show them how to put in our this week's case study.
That sounds like a great plan. Let's finish with PLTR. It's one we haven't looked at in a bit.
Yeah, I agree with you. That's a good one. Was pretty hot for a while, a couple years ago. And they tried back here. They mentioned the magic letters, AI, and got a little bit of a bid, came back down, didn't fill the gap. So keep an eye on that in the future. But we did hold a pretty strong area of support here at 20. We broke above it. Now we've broken above this resistance. It's in a wave 3 to the upside. We've got the same kind of problem here with the DMI that we do on the market, where the ADX is getting up and it's getting a little extended, and the positive directional indicator has already moved below it. So I think that was a nice move, but it doesn't look like something that you want to chase right now. Perhaps we come back down and test this 25 level. What was resistance now becomes support. We've talked about that numerous times. So I think it's a hard one to chase now. It is holding above the 10-day moving average, but based on that DMI, it seems like the strongest part of the move is over, and maybe at best we go sideways to slightly up from here. But I think that there's a possibility that we come back down to 25 and test that area and see if it holds. If it does, then that could be a good entry. I think that would be a better entry than where we are right now.
Alrighty, very well, Rob. That was a great presentation. Let's go ahead and wrap up this session by showing everyone how to post an idea, as you mentioned just a bit earlier. As for each of these TradeFinder Lives, I always like to try and show a different feature of the platform and go into just a little quick demo. As I've been saying in the past webinars, we are going to have much more detailed tutorials and webinars coming out here very shortly that will walk you through platform feature functionality. But for just a brief overview, I like to show different sections at different sessions. So for this one, I'm just going to show us where the discussion board community area is. We have an ever-growing community, as you'll see, and interact throughout the platform. You can vote on ideas, comment on what you think other people's ideas or your own are going to, and also just get ideas if you're maybe looking for a certain sector or just at a loss for where exactly you want to apply your capital. Then you can just maybe find some ideas from brainstorming with the community. We also have the Hub Live section down here as well, which is a show that Jeff does on Wednesdays on Hub, is on the platform going through, so you can go back and get caught up and see what he uses to analyze on those days. The last thing I want to show before going to the idea to actually post it on the platform is going to be the support window here. So just say we're on any chart and you experience any type of issue. We're working very diligently, as Rob's mentioned, to prevent you from having to discover any issues. We're trying to discover all those for you to avoid and provide the most optimal product we can. So if there's anything that you find that seems like an error or a glitch, you have the option to visit our help center, feature request. If there's something that you think would be great on here that you haven't seen or that you might not know is coming from beta to production, or if there's an actual error in the functionality of the web page, the best thing to do here is hit report an issue, and you can actually take a picture and annotate, or even record the error that you might be experiencing, whether it's not loading an invalid page or cache issue, things along those lines. So that's the demo for today. Let's go ahead and go over to the ideas and post the idea for this week's session. And Rob, that is going to be an official idea, not a post, right?
Correct.
Alrighty. So again, quick review. Idea is when you're ready to essentially execute the trade in real time, as if you were paper trading. Everything is real data at real time. You're just not actually putting any real capital on the line. There's no risk, so it would be paper trading. Essentially, a post would be something you have in mind. You're waiting for criteria to be met, and once that criteria is met, then you would post it as an official idea. So for this one, it is going to be COLB, and remind me where we're heading for that one, Rob. I've been doing a bit of typing on this session, so
2410. Yeah, it's unfortunately moved up 20 cents since we started TradeFinder. So just
already moving the market.
Yeah, it's been going up since we talked about it. So perhaps some people got in ahead of the official post. So just remember me if you make a gain on that.
Very well. Good shout out. Now, what was the time frame on that?
Let's see. Do the 2-month thing so you can show them.
Good idea. Yeah, so as you'll see here on the blocks, the intervals of time rather that are available, those are fixed amounts of times or periods of time. If you need something that is not within those periods, you can hit custom and go down to the very exact day that you would like. I always like to make sure it is a trading day, of course. So going 2 months out, the first trading day is going to be the 2nd here. Or sorry, we're in July 16th now, September 16th. And we will make this pretty as we wrap up the session. I know it's 6 minutes after time and everyone's got to get back to the markets, including myself and Rob. So I think that'll conclude today's demo for posting on the platform. I'll pass back over to you, Rob, to wrap things up.
Sounds great. Hopefully y'all signed up on that link, because we're going to have a great show tomorrow night. So we'd love to have you join us. And sorry about the limited Q&A, but lots of important things to talk about with what's going on in the markets right now. So thank you for spending part of your trading day with us. We'll let you get back to it. As Zach said, we're going to get back to it. And Zach, thanks for all your work. I know you are significantly multitasking behind the scenes. So thanks, everybody. Take care. Look forward to talking to you soon.